The S&P 500 reached an all-time high concentration. If we look at the top 10 list, it stands at roughly 40%. Over the last 35 years, it is the highest on the record. As an investor, I worry about these concentrations. But the question is, how did we get here and should we do something about it? Hey guys, I'm Andrei and welcome to my channel on investing. The US stock market concentration has been creeping up, but when it reached 40% lately, that grabbed my attention. The stocks in the top 10 list are dominated by the big tech like Nvidia and Microsoft. It seems that the bigger gets bigger, while the small ones just can't keep up. But has the US stock market always been this concentrated? Let's take a short history tour. In the early 1800s, it was all about banks. The first and then second bank of the United States dominated the US stock market. Back then there was no Federal Reserve. The Congress chartered the first and second banks of the US to transact across the country. They were the only national banks, so to speak. Back then the laws prohibited banks from transacting across state lines. So these huge banks were private institutions but with a 20% federal stake. And they did not set monetary policy or regulate other banks. They functioned as regular commercial banks. Back in the early 1800s, one of these banks accounted for almost 50% of the entire US stock market. That was by far the largest public company ever by that measure. In 1814, only about 70 companies had their stocks traded on public stock exchanges. But by 1850s, more and more banks and other insurance companies issued their stocks to the public. As a result, the top 10 concentration dropped. Until the 1830s, it was the prime time for financial institutions. They accounted for almost 90% of the entire US stock market. But things began to change around the 1840s as the railroad emerged. Railroad was a game changer for the US. In 1845, the Vermont Central Railroad took the crown of the largest company. Its stock market share fluctuated under 10% though, a far cry from those giant national banks. Still, this Vermont company remained the largest one until 1884. That's when Rockefeller's Standard Oil took the title. With ground transportation, it was easier to haul products across the nation, and that gave rise to many more new products and companies that never existed before. Ice companies, photography, radios, and more. And after the Civil War ended in 1865, the number of stocks grew from 267 to over 2,000 by 1895. If we look at the composition of the US economy, many more industries sprang up. The domination by railroad and banks was a thing of the past by the end of the 1920s. The top 10 concentration was below 20% right before the Great Depression. In 1929, the largest company, AT&T, accounted for only 3% of the entire US stock market. When the Great Depression happened, many companies went belly up. And in a matter of just 5 years, the number of publicly traded stocks declined by over 40%. And as a result of that, the concentrations at the top began to grow again. After World War II was over, the rise of so-called Magnificent Seven became noticeable. It was a mix of industrial and communication companies. They were top of the cream until 1960s. From 1945 to 1965, the US stock market rose almost tenfold on an inflation-adjusted basis. If we fast forward to 2014, many things have happened. Personal computers, globalization, mobile phones, and the rise of software. All this again gave rise to many more exciting companies and new industries. With the energy crisis of the 1970s aside, the US economy grew by unprecedented rates. And so did the US stock market. Up until 2014, top 10 concentration remained at about 20 to 25% on average. But from then on, the tech stocks have become unstoppable. Apple reached its $1 trillion market cap in 2018. It took it 2 years to double that. Today it stands at $4 trillion. But the crown goes to Nvidia with almost close to $5 trillion in market cap. Today the top 10 concentration of 40% is at all-time high if we disregard that 1800s episode. Very few non-tech companies score at the top. If we don't count Alphabet twice, there are 3 of them, which are Berkshire Hathaway, Tesla and JP Morgan Chase. The ironic thing is that Berkshire owns Apple stock. Its estimated value is close to $18 billion, or about 8% of Berkshire capitalization. Even Tesla touts itself as a tech and not an industrial company. History shows that concentrations tend to increase during bull markets, like what happened in 1990s. But when bear markets follow, the concentrations almost always fall. The main risk with concentrations is that they amplify both gains and losses. So if something happens to those 2 or 3 stocks, they can take the entire stock market with them. But without them, you won't get the same performance either. For instance, since 2021, top 10 stocks have doubled, but the remaining S&P 490 grew by about 20 to 30% only. So with that aside, what should an investor do? Is this a concern to act on? There are actually few ways to deal with this high concentration. And the first one is do nothing. A long time ago, I made a video why it is so hard to beat the S&P 500. The S&P 500 is just a reflection of what's happening to the US stock market. Right now, it's tech companies with large caps and immense profitabilities. The S&P 500 is just a precursor of what's ahead for the US stock market. And if something else becomes relevant, the S&P 500 realigns and readjusts to that. Companies don't become mega caps and some of the most valuable enterprises in the world. They have immense profit models as well as competitive advantages to back this status up. I like to study return on invested capital as a measure of profits. If we look at Nvidia, its return on capital exploded tenfold over the last 10 years. But not only that, its growth rates have been unprecedented by historic norms. We can be at the very early stages of something great happening. And markets, of course, can overreact and be ahead of themselves. And that has happened many times in the history. But long-term, markets are pretty good at guessing what's right. Either way, we can argue that staying invested is the only way to participate in whatever happens. And no matter how many data points we try to connect, the truth stays the same. Stock markets cannot be predicted. And those who try to call out that tech bubble 2 or 3 years ago missed out on that huge wealth-building rally that happened since then. Here's another way to stay invested in the S&P 500 but mechanically reduce concentrations, and that is to use equal weight ETFs. For instance, there's RSP fund by Invesco. If we look at its portfolio, not a single stock accounts for more than about 0.3%, even Nvidia or Apple. Now, this approach gives way more weight to smaller companies in the S&P 500. For instance, over 70% of its exposure goes to mid and small cap stocks. That's unlike the S&P 500 where large caps dominate. While this approach reduces concentration, but it has one major problem. For one, it gives way more exposure to mid and small cap stocks. As we know, the S&P 500 uses market cap weighting, and markets are pretty good at guessing the relative value of large cap stocks. But mid and even more so small cap stocks receive less attention from investors. And that's why I speculate that mispricing in that segment of the market can persist. Second, an equal weight approach has to often sell winners and reallocate funds to losers. And in the last 5 years, for instance, large cap stocks exploded, and so it had to sell them often and reallocate to something else. Conversely, the S&P 500 allows the market to take its natural course. For instance, if financial stocks take the lead right now, the S&P 500 goes there, and vice versa. On a historic basis, RSP did well, but that was until 2020 when big tech exploded. As we see, the lag between RSP and SPY widened. So RSP will be behind the S&P 500 if a few star stocks emerge with stellar performance. And by the way guys, as you see from my videos, I often use Seeking Alpha tools to compare ETFs and stocks. It's a great platform to research funds and equities. They are running a Black Friday promotion until December 10. I partner up with them. If you use my link below, you will get 20% off their annual subscription with a 7-day free trial. So check it out. The other approach is more like do-it-yourself and deciding on allocations. For instance, the most obvious way is to include more small and mid-cap stocks in your portfolio. There are many terrific funds for that. In my future videos, I will review small and mid-cap ETFs, so stay tuned for that. Also, another way is to allocate more to value funds. And value funds tend to focus more on dividend-paying stocks. And among those ETFs could be SCHD or VYM. I also reviewed them here on my channel. Also, you can add international stocks to your portfolio. Bubbleheads recommend anywhere from 20 to 40 to 45% exposure to foreign equities. And foreign stocks tend to have different sector allocations. and usually tech is not at the top of the list. Allocating away from big tech to something else can work, but may require some research. And the payoff is a more diversified portfolio based on your preferences. And that's all for this video. In my future analysis, I will take a look at mid and small cap ETFs. If you want to learn about international exposure and its importance in your portfolio, watch this video next. And as always, thank you so much for watching. I will see you at the next one. All the best!